Why are there people who never need to work their whole lives yet live in comfort, while so many others work tirelessly and still can't escape financial stress? The answer isn't about how many hours you work, it's about how you invest. And the secret of the wealthy isn't luck. It's their ability to invest for the long term, to plant seeds today and reap sweet rewards tomorrow. In today's volatile global economy, Vietnam, as well as many other countries, faces unprecedented investment opportunities. Among them, the stock market stands out as a channel that not only generates profit but also creates passive income, something we all dream of. In this video, I'll walk with you through 8 core elements for building an effective long-term investment strategy. We won't talk about getting rich quick. Instead, we'll explore a sustainable path, where discipline, knowledge, and long-term vision are the keys. If you find this video helpful, hit subscribe to Different Thinking and turn on the notification bell. As a thank you, I've prepared a small gift for you, a free ebook, Warren Buffett and Long-Term Secrets. The link is in the description and pinned comment. Leave your email or comment the word gift, and I'll send it right away. These are concise, practical insights you can start applying today. Don't miss this opportunity, because sometimes, just one small habit can completely transform your financial future. Part 1: Lessons from Warren Buffett. When we talk about long-term investing, the first name that likely comes to mind is Warren Buffett, the Oracle of Omaha. One of the living legends of global finance. People call him the greatest investor of all time. But what we should learn isn't just the fortune he's amassed. It's his mindset and long-term perspective, applied not only to investing, but to life itself. Here's a fascinating fact. If Buffett hadn't pledged most of his wealth to philanthropy, by 2023 his net worth could have reached nearly $300 billion, surpassing even today's top tech billionaires. But what makes Buffett extraordinary isn't the number itself. It's the fact that he has patiently invested for decades, regardless of market ups and downs. The wealthy share a common trait. They accept short-term sacrifices for long-term advantages. You can see this not just in investing, but also in business. Take Coca-Cola, for example. The company was willing to lose money for years when entering new markets, just to capture market share, and later reap massive profits. In Vietnam, companies like Buffett or Mobile World have done the same, cutting prices, sacrificing short-term margins, in order to secure their place in the market. This raises an important question for each of us. Are you willing to give up a small, immediate benefit today in exchange for greater freedom in the future? Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." If you're only chasing quick gains, you'll be like a small boat in a storm. But if you learn patience, you become a sturdy ship, harnessing the wind to go further. The stock market can make you wealthy in 10 years, but it can also wipe you out in 10 months if you lack vision. Buffett gives us a clear example. Long-term investing isn't just a financial strategy, it's a philosophy of life. So if you truly want to build financial freedom, start by learning to look a little further ahead, wait a little longer, and trust in real value. Part 2: Stop being addicted to the ticker. One of the most common mistakes investors make, especially beginners, is being addicted to the stock ticker. Every day they open their trading app, refreshing it every few minutes, heart racing as they watch the red and green lights flicker. The problem is that the ticker brings no real value, only temporary emotions. It makes you ecstatic when prices go up and despair when they go down. But do you know what's most dangerous? Allowing emotions to control your investment decisions. The market is always moving. If you let yourself be tossed around by every wave, you'll never go far. Imagine this. You want to sail across the ocean, but every time a wave rises, you turn back. Will you ever reach the other shore? Warren Buffett once said, "If you can't watch your stock fall by 50% without panicking, you shouldn't be in the market." What did he mean? That long-term investing requires patience and trust in real value, not in numbers flashing on a screen. Ask yourself, would you spend days researching before buying a gadget that costs a few $100s? Of course. So why is it that when people spend tens of thousands on a stock, many don't even know what the company does, sells, or who runs it? This is the paradox of uninformed investors. They spend hours staring at the ticker but can't spare a few hours to read a financial report or study the company's strategy. Long-term investing is not about betting on daily price swings. It's like choosing a tree to plant. You can't dig it up every morning to check if the roots have grown. You need patience, watering, caring, and letting time bring the fruit. So instead of being addicted to the ticker, learn to be addicted to knowledge. Spend time studying businesses, analyzing reports, understanding products, and following their strategies. That's the habit that generates real profit. Remember, the market doesn't reward the fastest fingers on the buy, sell button. It rewards those who wait and truly understand what they own. Part 3: The Value Investing Mindset. If you want to become a true long-term investor, you need a solid foundation: value investing. So what does value investing mean? Put simply, you don't buy a stock just because it's cheaper than yesterday. You buy it because the business behind it truly has value and the potential to generate future profits. Many people treat the stock market like a casino. But remember, if you rely on luck, you're just gambling, not investing. Value investing follows a different path, based on analysis, knowledge, and faith in long-term growth. There are 3 golden rules of value investing. Small accumulations lead to greatness. Stand on the shoulders of giants. And harness compound interest. First, small steps add up. There's a saying, a journey of 1,000 miles begins with a single step. Investing works the same way. Each month, you just set aside a small amount to buy solid stocks. After a few years, that capital plus compounding grows into something significant. Second, stand on the shoulders of giants. If you're not skilled enough to run a highly profitable business yourself, invest in companies that have already proven their strength: strong brands, capable management, competitive advantages. You're entrusting your capital to the best, letting them work for you. Third, compound interest. This is the magic of time. This year's gains are added to your principal, generating even more gains next year. Over time, your wealth grows exponentially. Albert Einstein called compounding the 8th wonder of the world, and indeed, only the patient get to harness its power. Picture this. If you invest $10 and grow it by just 10% a year, in 30 years it's no longer $10, it's nearly $175. Value investing teaches us one thing: wealth doesn't come from luck, but from habits and patience. So instead of chasing hot stocks or rumors, focus on the core question: is this a truly good business? And are you patient enough to stay with it? Part 4: Passive Income. Almost all of us have dreamed of a day when money keeps flowing into our account even if we no longer work. That's the power of passive income, income you earn even when you're not trading your time for money. So where does passive income come from in investing? It could be rental income, stock dividends, or profits from assets that generate returns automatically. But in reality, rental properties, the most common example, often bring only 2 to 3% annually in Vietnam after costs. In contrast, many strong stocks pay dividends of 6 to 8% annually, on top of the potential for their value to appreciate over time. This means not only do you receive steady cash flow, but the value of your assets also grows alongside it. Here's a simple example. Imagine you invest $100 in a portfolio of stocks that pay 7% dividends annually. That's $7 a year, enough to cover part of your living expenses. And if those stocks also grow in value, compounding turns that into a massive asset over 10 to 20 years. The key is to shift your mindset. Investing is not about hunting daily price swings. It's about creating stable long-term cash flow. If you only watch stock prices rise and fall, you'll get caught in emotion. But if you focus on cash flow, you'll find peace of mind and patience to stay the course. Warren Buffett proved this. When he invested in Coca-Cola, he didn't care whether the stock went up or down each day. What mattered to him was this: did the annual dividend keep growing? That cash flow became the foundation of his enormous wealth. So ask yourself, if tomorrow you stopped working, would you still have money flowing in regularly? If not, then it's time to start building your own passive income stream today. Part 5: Case Study, FPT Stock. Theory is important, But nothing is more convincing than a real example. In Vietnam, FPT stands out as a clear demonstration of the power of long-term investing. Let's go back to 2013. If you had invested about 36 million Vietnamese dongs, roughly $1.500, to buy 1.000 shares of FPT, you might not have expected much. But the magic came from patience. After 10 years, by 2023, those shares didn't just remain the same. With dividends and stock splits, you'd now hold nearly 6.000 shares, worth about 540 million Vietnamese dongs, around $22. That's not all. The dividends alone you'd have collected over those 10 years totaled more than 1.25 billion Vietnamese dongs. In other words, your initial investment didn't just grow 15 times, it also provided steady cash flow to reinvest or spend. Now imagine this. If you had kept discipline and invested an extra 40 million Vietnamese dongs, $1.600, every year, by 2023 your dividend income alone could be over 5 million Vietnamese dongs per month, about the same as a teacher's pension. This is the true power of compounding and patience. No need for constant trading. No need to stare at the ticker every day. All it takes is choosing the right business and holding on, and you've built a sustainable source of wealth. FPT is just one example, but it clearly shows that Vietnam's stock market holds many similar opportunities. No stock will be exactly like FPT, but there are certainly businesses that can deliver solid returns, if you're patient enough. So what's the lesson here? Long-term investing doesn't require flashy moves. It requires small, steady steps and a strong belief in value. Part 6: The 3P Criteria: Profit, Payout, Price. Now that we've understood the importance of patience and seen the FPT example, the next question is, how do you pick the right long-term stocks in the first place? The answer lies in the 3P to seconds, a simple yet powerful investing philosophy: profit, payout, price. The first P, profit, sustainable profit growth. A business is only truly worth your long-term commitment if its profits grow steadily over the years. Don't be dazzled by sudden, explosive, short-term growth. It often comes with risks. What you need is sustainability. For example, if a company earns $1 per share this year, $1.20 next year, and $1.40 the year after, that's a good sign. Because, in the long run, stock prices follow profit growth. The second P, payout, cash dividends. When a company consistently pays cash dividends, it proves their finances are healthy and their profits are real, not just on paper. Especially companies that both grow and pay dividends, they're usually market leaders with durable competitive advantages. Dividends also give you steady passive income. You can reinvest them to harness compound interest, or use them to cover living costs. Both bring you closer to financial freedom. The final P, price, reasonable valuation. A great company bought at too high a price can still disappoint. Remember, the biggest gains come from buying below intrinsic value. If you buy when the market undervalues a stock, you can profit handsomely just from the price returning to fair value. The FPT case is a clear example. Years ago, the stock traded at a P/E of just 7 to 12 times, cheap compared to its true value. Later, when the market re-rated it at 20 times, investors doubled their profits simply from this revaluation. So, the 3P to seconds aren't a complicated formula. They're a compass guiding you. Choose only businesses with sustainable growth, profit, consistent dividends, payout, and a reasonable purchase price. Once you master the 3P to seconds, you'll avoid many market traps, and your investing will be stronger than ever. Part 7: Portfolio Diversification. Imagine you own a golden egg. What would you do? Surely, you wouldn't put all your eggs into one basket, because if the basket falls, you lose everything. Investing works the same way. Portfolio diversification is a survival rule to protect your wealth. The basic rule: hold at least 5 stocks, spread across at least 3 different sectors. Don't let all your money sit in one company or one industry, because when the market shifts, the risk could wipe everything out. A common mistake many investors make is putting too much trust into one favorite stock. But reality is often harsh. The stock you trust the most sometimes ends up being the one that disappoints you the most. That's why the safe approach is to distribute evenly. Each stock in your portfolio should hold an equal share of your capital, no favoritism. This way, you minimize risk if one stock underperforms. Also, remember the buy and sell rule based on value. Buy when a stock is at least 20% below its intrinsic value, and sell when it rises about 5% above fair value. This keeps your portfolio balanced and efficient. Imagine you own a garden. If you only plant one crop, a shift in weather could ruin everything. But if you plant multiple crops, one may fail while others thrive. Your investment portfolio works the same way. Diversification won't eliminate all risks, but it keeps you standing when markets get stormy. More importantly, it gives you peace of mind, knowing you're not betting everything on a single throw of the dice. So before asking, which stock should I buy? First ask, is my portfolio balanced enough? That's the mindset of a true long-term investor. Part 8: Discipline and Investor Psychology. Investing isn't just about numbers and analysis, it's also about discipline and psychology. In reality, many people lose money not because they lack knowledge, but because they can't control their emotions. Imagine this: the market crashes. Stock prices fall daily. Fear pushes you to sell everything. Yet it's in these moments that the biggest opportunities appear. Without discipline, you'll sell valuable assets cheaply and regret it later. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." This isn't advice to be reckless. It's a reminder that going against the crowd requires courage and iron discipline. Crowd psychology is the biggest trap for investors. When everyone's buying, it's tempting to follow. When everyone's selling, fear takes over. But successful long-term investing means staying calm, looking beyond short-term fear. Discipline also means sticking to your investment plan. If you've decided to buy quality stocks when they're 20% undervalued, then be patient. Don't rush in when prices are still high. For example, some investors patiently hold stocks for 10 to 15 years. Weathering storms. When the market recovers, they reap the rewards. Meanwhile, those who lacked discipline gave up after just a few months, missing the biggest opportunities. The right mindset helps you sleep well, even when the market is burning red. Because you know you're holding strong businesses, and time will prove their true value. Long-term investing is not a sprint, it's a marathon. The winner isn't the fastest runner, but the one disciplined and patient enough to reach the finish line. Conclusion. After walking through lessons from Warren Buffett, value investing, passive income, the 3 P seconds, portfolio diversification, and investment discipline, you can see one thing clearly: investing is not gambling. It's a journey of building value and lasting freedom. The market may fluctuate daily, but true wealth comes from patience, discipline, and faith in good businesses. If you apply the right principles, even a small daily habit can transform your financial future. Remember, you don't need to be rich tomorrow. You just need to start today, with small but consistent steps. One day, you'll look back and see how far you've come. If you found this video helpful, hit subscribe to Different Thinking today. As a thank you, I prepared a free gift for you, an ebook titled Warren Buffett and Long-Term Secrets. The download link is in the description and pinned comment below. Leave your email, and I'll send it to you right away. Or simply comment the word gift if you'd like to receive it. This is condensed knowledge that can help you start changing tonight. Don't miss this chance, because one small decision today can create a completely different future for you. Thank you for watching until the end. If you found value here, subscribe, hit the notification bell, and leave a comment. I'll personally reply to your questions. And don't forget to check the playlist in the description to continue the full journey.